We've got V. Vaidyanathan of Future Capital. Vaidyanathan is coming to you, and based on what Shanti just said, would you say that tomorrow's event is going to be a bigger clincher in terms of rate cuts happening than the very fact that inflation continues to be sticky?
Well, tomorrow is a very important day in the sense that it signals the resolve of the government in the context of the political equation. So to that extent, it's a really, really important one. But the other really big one, though we talked about oil, but I'm not very sure that we have really understood the impact of this big animal called oil. We've talked about it ad nauseum. For every $10 increase in oil, there is a $7.5 billion impact to the current account deficit, and therefore there is a big impact on fiscal deficit as well. So oil is a really big one, and steadily at $125 odd for a long period of time is really drilling a hole into our fiscal. So I think sooner or later it is going to get passed on, irrespective of political compulsions, and as that gets passed on, RBI will be concerned about the resultant inflation caused by that as well. So there is an issue there, and I do not think that even in April, so to say, that the situation is going to get that clear. And I think they may take a little more time, though we will all wish for this to happen in sometime in April, because March has of course gone by. But I would suspect that even April, I would put it only at a 50-50 chance. I wouldn't take even April for granted. One thing is certain, that the RBI is pinning down the government really very hard for the last few monetary policy announcements, saying that, look, you've got to do your job. And I think that's very significant. It's an unequal stand, and it's not a confused stand at all by any means. We should also, of course, remember that while we, of course, taken the interest rate reduction for granted, we're just talking of timing. The fact that interest rates are poised to come down, whether by 75 basis points or 100 basis points over the next 1 year, is in itself a very significant development, should lift the mood/spirits maybe in a month or two. But in itself, it's a very, very important development. From all RBI's comments, they're talking about cutting it. They're not, the issue is only when, issue is not whether it will happen, and that is really positive news.
Non-bank sources of funding to the corporate sector actually exceeded bank sources of funding by the third quarter of the current financial year. Do you expect that trend will hold up, or do you believe that as interest rates come off beginning April, we will see bank sources of funding once again exceed that of non-bank sources?
No, in fact, it's the other way around, actually, because we expect that the market sources, as in through maybe public debentures and so on and so forth, starting to contribute more to the funding for the non-banking financing system. Of course, banks continue to be an important source, no doubt, but in the environment of very tight liquidity, I do think that we actually have to wait for the interest rate reduction for this source to actually open up a lot more. And we should just understand that the overall credit demand has not been that high. It's been close to about 16% this year. So banks actually are looking out to extend credit, and when they find good sources of credit being done through non-banking finance companies, etc., I'm actually finding that raising funds from the banking system is not difficult at all at this point of time.
Given that earlier CRR was seen as a monetary policy tool, now that it's seen as a liquidity assessment instrument, how would you look at the future trajectory of RBI actions?
Before I come to the future action, I'd like to make a separate point in the same context.
Sure.
I'd like to take you back to 2005, 6, 7. If you recall, there was a lot of flow of dollars into the country. The RBI forced to buy the dollars, infuse rupee, and then there was a lot of excess of liquidity, and the RBI had to, increase the CRR to suck back the liquidity, and therefore there was the other problem of plenty. And we're talking of a period now when it's the other way around. We're saying we're actually intervening to support the rupee, and then there is a 100,000 rupee shortfall cost because of that, and therefore it's almost a contra of what has happening in that phase of 2005 to 2007. I think this very significant change that has happened in the overall monetary situation, and it's actually not so much a monetary situation, it's actually a government policy-led economic growth kind of a situation that we are seeing. I think this change has to be recognized, and I think it will be really pertinent if the government spots this change and does something very, very significant to bring back the economy on growth path again, and acknowledge that they had a role in the slowing down of the economy from 9 to 6.1 and to bring it back. And I think that acknowledgement is important for us to reverse the change. Now, coming back to your particular comment about where do we see this headed, I still am skeptical whether this would happen even in April, because I do think that there are because the RBI has taken a very direct straight line relationship, and probably with the right wisdom between inflation and growth, and therefore between inflation and cutting interest rates, and therefore in this context, it is going to be unlikely that even in a month from now, the trend on inflation is going to be very, very clear in the light of the oil problem we talked about. Therefore, I would say that it's probably going to wait a little longer, would probably be our guess. But we'll have to wait for the next policy in April to comment upon this again.